Welcome to Fund to Money, your 24/7 buddy on all matters related to personal finance. Now, in this web series, we are discussing various things people need to keep in mind while investing in stocks. We're talking about the big picture things, the larger things which are not related to the company, which influence your stock market investments, which influence share prices. Now, these are things which are not related to a company per se, but the larger factors, say basically economic factors. Now, in this particular segment, we would be discussing the impact of inflation. That's right, inflation which impacts all of us, including stock market investments. That's coming up shortly. Now, as I was mentioning, inflation actually impacts stock prices and stock market investments. How does it do that? Well, to give us a very lucid sort of a picture, a clear picture, we have with us our stock market expert, Mohit Satyanan. Hi, Mohit.
Hi, Udayan.
Mohit, I mean, you can get anybody to talk about inflation. So, but the most of the time they come up in stock market discussion in the running. People talk about inflation going high or low, and that's why things should stock prices are going up or down, whatever. What is really the linkage? When we are talking about inflation, we are talking about the rate of price change. Isn't it a general price? Now, how is it impacting a stock? How does a regular investor figure that macro thing out on his individual investment?
Before answering that question, I'm going to answer another question, which is to what extent should an investor look at inflation in terms of managing his overall net worth? And I think that the average Indian investor the average Indian household does not think hard enough about inflation. And the reason I'm saying this is that if we actually thought enough about inflation, none of us would put money into fixed deposits. Okay? I like to think of inflation in India at a very broad, long-term secular basis. And on that basis, I look at inflation as being between 7 and 8% per annum. Now, this means that if I put money into fixed deposits and I'm paying any income tax, I of course pay 30% on the margin, but even if you're paying 20%, you get 8% from the bank on an FD. You pay 20% of that, that's 1.5%, you're getting 6.5%, which is less than the historical average of inflation, which means that you're actually paying between the government and the bank, you're actually paying somebody to hold your money.
Mm-hmm.
Historically, again, if we look at the long run, equities return about between 12 and 15% per annum.
Depending on the state of the market.
Depending on the state of the markets, which 2 points you're looking at, are you looking at the Sensex or the Nifty or small caps? Let's say 12%, plus an average dividend yield of 1%, 13%. 13% minus even a 7% inflation. You're looking at 6% return year on year over the long run. So you're not comparing 13% on stocks with 8% on FDs. Actually, you're comparing in terms of real purchasing value, which is all that we are concerned with. You're comparing 6% with minus 0.5%.
Mm-hmm.
This is the most important inflation number to think of.
Sure.
Now let's talk about inflation and stocks. Okay? And lastly, let's talk about inflation and government, because I think that's another aspect of inflation which people don't look at. India is an economy which has lived with inflation throughout its history. Unlike a lot of economies, if inflation in India is 5 or 6%, it's no big deal. There are other countries where inflation over 2% is considered very disturbing. It's not in India. People have grown used to 5, 6, 7, 8%. The RBI is trying to constrict that band. I think it's a good thing. But I think that inflation below 8 or 10% is not something that we need to worry about too much as investors. Because our companies know how to deal with inflation.
Sure.
And if a company knows how to deal with inflation, that means that it's going to figure out a way to protect its earnings irrespective of what inflation is at a broad level. And therefore, as long as it's within these broad parameters, it doesn't worry me hugely. Okay. Now, there's a lot of talk about inflation in our pink press, in our financial journals and on business channels. And the normal link that is being discussed is, if inflation doesn't go down, interest rates won't go down, and if interest rates don't go down, the economy won't grow, and so on and so forth. As I said in another segment, this whole thing of interest rates being low or high, it doesn't worry me hugely. There was a time when interest rates in our country were 14 and 15%. Yes, today we look at 7 and 8%. But between 8% and 6.5%, I don't think it matters. If I'm a company manager evaluating a new investment, and I say that the difference between 8% and 7% is going to determine the future of this investment, whether I make it or not, then there's something wrong with that investment. Because the cost of capital, except as I said for infrastructure, is not the most significant cost of a project. It's only one component. And therefore, interest rate personally doesn't worry me too hugely.
So what you're trying to say is the critical fact is how smart the company is. Can it smartly run its business? Can it smartly adapt and generate earnings despite
Absolutely.
So that's a more critical part. Of course, we'll be discussing inflation and government finances in another segment, but this is a very interesting point which Mohit is making, that whatever those headline making numbers are, it's down to the company, which is how smart the company is, and you have to take a story by story, and which is the story that you believe in, and you put in money for that story. So just in case you disagree with Mohit, or you agree and you have got another perspective, go down to the comment section and just type in your comments. Go to the description section for edited transcripts of this discussion. If you like this video, what are you waiting for? Go and click on the like button, and of course we would love to have you subscribe to our channel. And last but not the least, stay connected with us on all leading social media platforms.